This episode of 30 Deals, 30 Days is brought to you by the CRE Accelerator Mastermind. If you are interested in learning to do deals like what we've been underwriting here, working with me to make that happen, and 170 other really awesome people that are all closing deals, 19.5% of our members are making over 10K a month now. We've only been around for 2 years. Then go to crecentral.com, learn more from that. Now, you're probably asking, Tyler, why are you doing the the bumper ad live? Well, I'm down in Mexico. I'm in Cancun for a buddy's wedding. I told you guys I'm not going to miss it. We are going to make sure that we are still doing 30 deals, 30 days live while I am here. So bear with me on the screen not being as pretty as it typically is when I'm in the studio. But if you are just now joining this challenge, this is where we're going live every single day, 30 days in a row to underwrite commercial real estate. That way you get an idea of how I go about this process, how I underwrite commercial deals so that you can go and do them yourself, right? That way you understand my approach. You can start applying that to deals in your market, whatever you've got going on, so that you can start running numbers, analyzing these deals, and hopefully buying and scaling your commercial real estate investment portfolio. If you haven't joined the challenge yet, you can join the challenge. You'll get access to the tools that I will be sharing with you today. We'll be using my commercial underwriting spreadsheet, which we have designed specifically for these types of deals. You can get that for free. You can get my course for free for the next 9 days. This is the 9-day countdown. We're already on day 22. So, keep that in mind. We are getting close here. This is funny. I mean, since I am not in my studio, there's a lot of stuff that I cannot do. I can't bring everybody's comments up right now. So I will say, I'll just read them out. Z is saying, take a break, go party, dude. It's okay to skip a day. I don't mind. Look, it's an in-between time. It's 4:00. Everybody's been hanging out all day. It's kind of that, hey, go back to the room, rest, and then come back. Spyro saying, let's go. I'm back. Respect that you're still alive even while away. Well, cheers, Spyro. I appreciate that, man. Oscar is present. You are killing it, man. Oscar, you're killing it. I'm glad you guys are here. All right, let's get into today's deal. Let me share my screen here real quick. All right, I hope it's coming through all right on y'all's end. So this one's from Zach. He posted this in the 30 Deals, 30 Days chat, which, by the way, if you haven't submitted a deal yet in the chat for me to look at, for me to review, to dive into, maybe in your neighborhood or the type of deal that you're trying to buy, what are you doing? I'll show you exactly how I'd be underwriting that where you are. So Zach is saying, hello, Tyler and all. I'm a new investor in Birmingham, Alabama. I'm currently looking to purchase my first industrial flex property. Cheers, man. That's really exciting. I think that's a great first step into commercial real estate. Saying, Tyler, your channel has significantly helped accelerate the learning curve. That's really cool to hear, man. I'm glad to hear that. It's always nice to hear people say that it's been helpful because, I mean, as you guys can see, I'm recording this by myself in a hotel room in Mexico right now. So it's always very humbling to me that there's actually people out there. You guys are actually out there learning and implementing the stuff that I'm teaching. I find that really neat. Some extra info on the deal. Seller owns free and clear and is retiring and sold their business. That's great. Maybe we can do some seller financing. Property is currently vacant. Some parts of the roof have been updated when the office was built out. Don't have the year. The rest of the roof and HVAC is original. I wonder when it was originally built then. Smaller building has no HVAC. Broker said they're getting leases done at 750 to 850 triple net in the submarket. 2025 taxes were 10,300. Zach, you're already making my job easier by going out and talking to brokers. Let's see what we can learn about this deal. So looks like a pretty nice flex building. I like it. You're right on a highway, good visibility. We were talking about this the other day. I mean, one thing right off the bat that could help a tenant is to have a big old sign right there, make it very obvious where these guys are. Looks like they're using a little bit of a lay down yard kind of over here. So I'm assuming this is the smaller building. He said has no AC. That's probably just for storage, maybe lay down as well. So it looks like it may be 1.5 or 2 stories. You got a roll-up door, plenty of parking. I mean, this is nice. You got plenty of parking opportunities here. Okay, you've got some covered laydown as well. I love buildings like this, man. You know, they really remind me of one of the first properties I ever worked on, which was my grandfather's property. He still has it, and we're still leasing it. You know, it's been going on like probably 10 years at this point that I've been working on that property. And you know, he was in construction, so he had a building very similar to this. I love these types of buildings. Let's see. Okay. I mean, these are they look like they're in pretty decent condition. I love that they're not flat. Flat roofs are great. I mean, you know, they're commercial. That's typically what you'll see. But man, when you can just have a sloped roof like this, it makes your life so much easier as a commercial real estate investor. It really does. It's not always feasible, but I do like it. Interior is nice. I mean, that's a good build out for this kind of office. You know, it doesn't need to be fancy. It just needs to not be dirty and worn out. And that's exactly what this says. It looks nice. And it's just great. They actually have plenty of photos. You guys have seen some of the deals that we've tried to underwrite where they just have nothing, not helpful at all. So, oh, that looks great. Look at that. So one of the first things that I always check when I go inside these buildings is what does the insulation look like? You know, because sometimes you'll see that this will, you know, stuff will hit it. It'll start to get torn. It'll fall off. You know, you look up over here, like this insulation's in pretty good shape, which means to me, like they've probably taken pretty good care of the entire building. I feel like I saw some welding equipment maybe, so it seems like they might have a pretty decent amount of power. Depends on the type of welding equipment that they are using, but generally welders have, you know, high power requirements. Um, so saying 10 private offices, small fenced gated side yard. That's this spot right here, which is nice to have. Plus or minus 8,000 square feet of industrial, warehouse, or manufacturing space. Looks like you have around about 1,200 square foot for a shed for storage. And then ceiling height in the main building's 20 feet, 17 to 20 feet in the shop building. So that looked like it was a half story, right? I mean, it looked like that was not actually 2 stories of office space, which we appreciate. All right, I'm gonna stop sharing real quick and come back into the stream and make sure. I can't see the comments since I'm not in my studio, and you guys sometimes will say like, "Hey, I can't see anything," so I want to make sure that I haven't missed anything. Jim Chambers is saying, "Hey Tyler, hope you're having fun down there." Jim, appreciate you, man. Good to see you, dude. Hope all is well down in Florida. Oscar's saying, "Love the American flag." I know that thing is huge, a giant American flag. Amanda, finally able to join live. I've enjoyed working through the recordings. Thanks, Tyler. Absolutely, Amanda. I'm glad you're enjoying it. Okay, let's jump back into this baby. Let's see. So 12,500 square feet. Now, the thing is, like, we're really going to have to underwrite this as 2 kind of separate buildings. Because remember, they said that the 1,200 square foot shed is really just for storage. I mean, it's nice to have that, but you're not going to get the same price for that as you are really everything else. But I wonder because, you know, Zach over here was talking about how he talked to a broker. They're getting leases done at 750 to 850 triple net in the submarket. I wonder if that might include some space like this. So that could be interesting to see. Main building includes plus or minus 4,500 square feet of office and conference space. I take that back. Maybe it is 2 stories. That is way too much office space. That's a ton of office. I mean, you're talking 50, almost over 50% of the building is office. Most users do not need that much. Let's see, 4,000 square feet of warehouse industrial space, plus or minus 4,000 square feet of warehouse. Additional storage and 50 by 24 foot shed on fenced backyard. Okay, well, maybe. I wonder what Yeah, I mean, I think it's this smaller. Okay, I'm just making sure that I didn't misinterpret that this smaller building doesn't have HVAC. It looks like it's the one that does not. Man, I'm kind of floored at how much office space that they have. That's substantially more than I would have thought. 4 per 1,000 parking. That's really good. So that means 4 parking spaces per 1,000 square feet of space. That's really good for a property like this. Immediate opportunity with signage there. It looks like they may have a sign, but come on, that's not going to get you anywhere. Let's see here. 12,500 square feet, single tenant office, warehouse facility. Plus or minus 1,200 square foot shed. Asking $850. That seems pretty reasonable. 2 stairwells, training and conference rooms, 10 private offices, 4 grade level drive-in doors, 1 drive-through bay. So a drive-through bay, if you're not familiar, is literally where you can drive through the building. That can be pretty nice if you need to work on trucks, or if you're unloading trucks inside, or you just want to store trucks indoors. Those are always pretty nice. 200 amp, 208 volt, single phase power. So that's pretty decent. Okay, that's what we were looking for. The shop actually has 3-phase power. Notice I noticed this welding equipment right here, and I was like, man, it looks like they're really processing some metal in here. Typically, when you see welding or anything like that going on, they need 3-phase power. Look, I'm not an electrician. I couldn't explain it all to you, but I will tell you, 3-phase is a lot more power than single phase. Okay. That seems about it. I'm going to check on you guys before I pull up the underwriting and see what we're going to be diving into. Zia saying, want to join your mastermind. If I had a monthly membership account, would make it easier. Oh yeah. I mean, we offer financing options. So, I mean, if you're a good fit for the mastermind, I wouldn't let that hold you back. We'd be happy to help you split it out, make it more affordable. Okay. Let's pull up our underwriting spreadsheet here. They're asking, oh, it's getting a little squirrely on me. There we go. Zoom out just a little bit. Okay, they're asking $850,000 for this bad boy. We'll come back to the capitalized rehab. I don't know that we're really going to need much, to be honest with you guys. Sorry. Creating an infinite loop there. They're saying that it is a total of warehouse space is 8,000 square feet over 2 buildings, 4,500 square feet. So 12,500. Let's just say that's the number that we're going with. Closing costs, we'll get this down to 20 grand, maybe less than that. Let's say 17.5. Down payment. I feel pretty good about being able to bring a 25% down payment on this one. I say that because I think 30%. We did 30% yesterday, or maybe it was the day before when we had last talked about that. And, for some cases, it's kind of a gut feeling. It's just based off of the conversations that I have with lenders of what they will and won't like, to be honest with you. This flex space should be relatively easy to get filled. They should like it. Interest rate, I feel confident at 7%. We'll do a 20-year amortization on that one. And let's go with the low end of what we were told this might lease for, right? So $7.50 a foot. We don't have any other miscellaneous income or additional income streams, so we'll just leave those blank. Now, this is really a single tenant property. So let's say we're 100% vacant for 6 months. Whoops. And then we stabilize from there. I'm still going to leave 7% vacancy in there. One, because the bank's going to do that to you anyway when they do their underwriting. And so I want my underwriting to kind of look as close to the banks as possible. That way I know if they're going to approve it or not. But two, it's just a more realistic way of actually looking at what you are underwriting. Because at some point, this tenant might leave earlier in their lease, and they might be out for a few months, and then you put another tenant in there. Well, all of this vacancy will add up to cover whatever vacancy you actually ended up getting. So that's kind of why I do that. All right. We will pay 6% in leasing commissions. The first, let's see, we were told that property taxes were $10,300. So we'll have to pay half of that, right? Because we're gonna have 6 months of vacancy. And then maybe some utilities for a little bit. I'm going to say that our expenses all in for the first year are going to be 10 grand. And then we'll pass that off completely onto the tenant. So what is that? 80 cents a foot. Oh, nailed it. The third time. Okay. So what we'll do is this is us paying 100% of property expenses for the first year. This second year, I'm actually going to drop it down to 50 cents a foot. And we're going to mark this one red since I broke. Okay, we're going to mark it orange since I broke the formula there. That way I just remember that. That way, I think that we're still going to have some expenses every year, right? That could be asset level. That could be, we got to hire an attorney for something. We've got to pay for our K1s to get distributed to our investors, whatever that is. You're always going to have some sort of, expenses. So even though it's triple net, I like to underwrite, my expenses being carried there. Well, the pro forma shakes out pretty well. I feel like we're missing something here, though. Aha. Look at that. See, this is hard-coded. That's not right. Which means that none of this is right. And this is why it's so important. See, you guys, even I make mistakes. That's why I always say, hey, just download a new one. All right, that equals that. This equals this times our 103%, and then that fixes everything else. All right, so we should be good to go there. Let me double check this formula. D34 times F10, which is our square footage. All right, I feel good about that number. Now we're looking a little more realistic, right? Because I was like, man, that first year we're basically completely vacant. We shouldn't even be covering our debt service. Second year, not so hot, but it looks like our third year, we actually start to stabilize out a little bit. And look at this. I noticed another anomaly. So why does it go from 1 to 145? That seems like a big jump, especially when the next year is only 149. So then I know, okay, let's go to this column and start looking at what's going on. Well, this 30,000 has been hard-coded, and I didn't even mark it. See that? So hard-coded. So I need to see if I can just drag this over. Equals G52, which is this, times E10. It should be F10 plus G54. That's correct. Really should be G53 maybe. No, yeah, G54 for commissions. Okay, there we go. Now we've fixed our debt service coverage ratio, right? So that works. I wish I could tell you guys I totally did this on purpose because I wanted to show you guys how I find anomalies and mistakes in my spreadsheets, but we're doing it live. So you never know. The other thing that I'm noticing is that my 6% commissions aren't calculating. So it looks like that formula has been completely wiped out. What I'm going to do is I'm going to equal this times, so 6% times the lease value over 5 years. And since we're signing pretty much everything in year 2, we'll just leave it right there. Look at that. That's kind of funny. It brings it back up to 36,000 anyway. So it completely kills our debt service coverage ratio on that one. All right, I'm going to pause, come back to you guys, and see if there's any questions in the chat on what we're working on. Let's see. Z's just saying, sweet, I'll look into it. Okay, cool. You guys are quiet today. I know it's a little bit different from how we're typically doing things, so maybe that's adding on to it. Yeah, if you guys are enjoying this, let me know in the comments. Let me know what question you have. All right, let's get back to this. Ooh, infinite loop. Okay, I'm going to underwrite this at first as if we are not raising capital. We'll come back through and work on some of this. I think capital reserves of $37.50 a month. I'm sorry, $37.50 a year is probably a good number to have as you're going through that. We are not raising capital on this one. And so look at that. First 2 years, not super great. We are losing money because it takes us a while to get a tenant, and then we got to pay our commissions, which I guess technically should be fully loaded into the first year since that's when we would be paying it. Let me do this. I'm actually going to copy this formula. I'm going to move this into the first year. And then I'm going to zero that one out. So now I've got to sum this out. Finding more and more that's broken. It's always fun. All right. That brings that to 39,000. Okay. So this is good. That's actually pretty good that happened because now we actually hit our debt service coverage ratio in year 2. That's typically when a bank is going to want you to hit that debt service coverage ratio. All right. Remember, we're aiming for a 1.25 debt service coverage ratio minimum. That's what I like to aim for. You may find a bank that says, hey, you can hit a 1.2, and that's fine. Now, one thing that I want to double check, since apparently my spreadsheet today, at least the one that I opened up, is completely broken. I am losing $56,000 my first year. Let's make sure that my operating capital is telling me to bring $56,000 the first year to cover those losses. And it pretty much is. It's saying 61,000. So that's giving me a little bit left over after we cover all of our expenses. So I like that. That's good. Now look at that. Years 2 through 5, we actually cash flow 7 to 8%. I mean, not phenomenal, but not terrible either. Here's another anomaly. See how this goes from 7.03 to 7.89 down to 7.32? Now we want to go up and see why it might have gone down, because theoretically, our returns should have continued to go up based on the way that this spreadsheet is set up. So nothing changed here. Oh, maybe something did change here. Okay, notice that our mortgage interest actually went up because these were hard-coded and not marked. Oops. All right, let's do this. Just copy this formula. We'll just drop it in here. So that is not right. All right, there we go. You guys tell how much time I've spent in this spreadsheet? Like as soon as I start seeing a problem, I'm like, oh, yep, okay, let's go and fix that real quick. That's why I get too comfortable. Sometimes I'll come in here, I'll underwrite it, and I'll be like, oh, I don't need to mark anything red because it's super easy. I'll remember this. And then of course I go live with you guys. I don't remember any of it. Okay, so see how that fixed our cash flow? Now we go from 7.03 to 7.89 to 8.77 and 9.69. The way that this is calculated, since it's a single tenant deal, there's one tenant, we're going to sign a 5-year lease. They should be there paying 3% more rent every single year. So that should continue to go up every single year. This is a local credit deal. I doubt that we're going to get anything lower than a 7.5 cap rate. Now, the way that this is set up right here, right, our net refi and sale proceeds, really what that's saying is that we're actually refinancing. because it's at 80%. That's assuming that we're leaving roughly 20% equity in place. Now, of course, it probably end up being like 79 because you'll have to pay a point to refinance or a half point, something like that. I'm just going to assume a sale. And so I'm going to do it at 93%. Now, I do that because we're saying we're taking 93% of our sale proceeds will hit the bottom line. Or really, I guess it's the gross line, because 7% is coming off the top for your 6% in commissions and 1% in closing costs. All right. That's where we get that from. Now, look at this total return over 5 years. Pretty decent. 89%. I always aim for close to 100%. So this would be a deal that would be worth looking at based on what we're seeing right now. You're essentially saying, hey, we're going to make 18% on our money annually. Now it's annualized. That just means starting year one, you're going to actually make 18%. But when you take into account all of the money that you make on this deal, after you pay off your debt service, after you pay back your capital accounts, you take your profit, you're making about 18% on your money every year. That's a pretty good option. Now, let's say that we did decide to negotiate for seller financing. Maybe we don't have $212,000 to bring down, but maybe this guy's ready to get out of this deal, right? We're just going to run some stress tests on this to see what it could be like. I'm going to say I'm going to bring 10% down. All right. Maybe I only have access to $85,000, but the seller is interested in carrying a loan because they don't have anywhere else to place their capital. I've showed them how great seller financing can be for them and their portfolio. We're going to drop it down to 5%. And then I'm actually going to come down here to our principal reduction, and I'm going to turn this into 0. I'm going to say that we're going to do interest only for 5 years. Now, I'm going to be smart about this and actually mark these orange so that I can come back and see what's going on. So basically, the way that I have now structured this spreadsheet, and keep in mind, this is the exact same financing, right? Box. So I just changed it into seller financing by saying, hey, we can kind of change our terms around. So we're putting down 10%. We're paying 5% interest only. We're not paying down any principal over the 5 years. So this thing should cash flow like crazy. Let's see. Look at that. 29%, 30%, 32%. That would be a hell of a deal. Now, it'd be tough to convince a seller maybe to do 5% interest only. Let's say maybe they only agree to 8% interest only. That's a pretty decent amount for them. Like, they've got some good money coming in from there. 11% to 15% cash on cash returns. Now, you got to figure out what the hell you're going to do that first year, right? You still have to bring another $57,000, $58,000 to the table to pay for the interest carry while you are trying to find a tenant. But look at that. You're almost doubling your money there, right? That's a hell of a deal if you could negotiate that one. Now, let's say that I decide to go the bank route, but I have to bring $50,000 in rehab. All right. Let's go back and fix this. This equals, and here's our principal right here. And then I think if I just put a $, that I can then carry this over and it'll be the same. Look at that. I'm not a spreadsheet wizard, but sometimes I surprise myself. So there we go. Now we've basically brought it back. And let's do left border. Oh, that's fine enough for now. We have to bring $50,000 in rehab on this one. All right. 25%. I'm assuming that we're going to be closer to an 8% interest rate if we're going to the bank. But with that $50,000, maybe I'm able to get $8.50 a foot. Right. My expenses are going to be the same. They're not really going to change, but look at my debt service coverage ratio. That's even stronger. Even though I'm bringing in an additional $50,000 to put into this property, still a very strong debt service coverage ratio. My cash on cash returns are very strong. And look at that. We're more than doubling our money over 5 years. We're getting close to a 27% cash on cash return. I like this deal. I mean, let's see what happens if I bring $50,000 to the table and I still can only get $7.50 net. See, my cash on cash returns aren't great. Like we're not gonna retire off that, but it's not bad. Like, I mean, here's the thing: the kind of real estate that we're doing, if you're making 5% cash on cash, that's pretty good. Because remember, we're looking at it over a 5-year term, not in any one snapshot of a year. 63% on your money, so roughly 12% per year. I wouldn't get out of bed for the deal at that point. So then you start thinking through, okay, well maybe that's the only way. Like we only feel confident we can get $7.50 a foot. We have to bring $50,000 in rehab. I'm going to knock his purchase price down by 50 grand. Remember, we didn't change anything else. We were at 66% last time. 7 to 9% cash on cash returns. Look at that, jumps up to 90% cash on cash. So roughly 18% annualized returns over the 5-year period. So I think this is a pretty decent one. I mean, it's definitely worth digging into, especially if you can start for some seller financing terms, because that's how you're going to really, really start to juice, that deal, Zach. Looks like Jim is saying offer 800K. Yay. Hey, great minds think alike, Jim. I love that. Let's see here. Nate is asking opinions on possible 50-year mortgage for residential properties. I'm actually going to make a video about this. I've been thinking about it because I think it is absolute idiocy. It is the dumbest thing in the world to start dangling a 50-year mortgage in front of people. I think the 30-year is as far out as you should ever go. I really do. Like when you start to run the math on like the average mortgage, I think the average house or average homeowner would save $300 a month on their payments. But think about it. Now you're only saving $300 a month. You're now spending an additional, let's call it $2,000 a month for 20 more years. What is 20 times 12 is 240 months. You have another 240 months at $2,000 a month. So you're now paying an additional $480,000. $480,000. That's like more than the average house. So you're paying the amount that you would pay more in interest on a 50-year mortgage is sickening. And it doesn't actually save you that much money. So in my opinion, it just cons people. It's a con. That's how I feel about it. But I'll make a video on it that will have a much more educated, formulated take on that, because I think it's important for people to know. I would never, ever, 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 ever do anything more than 30 years. I wouldn't. Because you never pay down your principal. You never catch up. Let's see. Oscar saying learning more and more each underwriting. Thank you, Tyler. Oscar, I'm glad to hear that. I'm hoping you guys aren't getting bored with this because we still have a few more days. But I'm having a lot of fun. I mean, every single deal you guys have submitted has been different. So it's cool to kind of compare and contrast the differences between all of them. Zia saying when you deal with numbers all day, it gets easier and easier. Yes, it does. Damn, I can buy a Lamborghini finally. Absolutely. Yeah, offer 700K. That'd be hilarious. But yeah, I mean, that's the thing. Like we showed in the underwriting that $800,000 really works. $850,000 actually works too, if you are structuring it right. So anything that you can get it for less than that, gravy on top. I mean, that is the icing on the cake. So yeah, that's not saying like, hey, we should go offer him $850,000. I still want to get a good deal, right? I just know now my numbers will work at $850,000 if worst case scenario, that's the only number that I can buy it for. Jim is saying, I think it would help some people qualify to buy now and they can refi down the road a few years. I agree with that. I mean, I do see the pro of being able to qualify now. The problem is, though, I don't think that like 7% interest rates. I mean, most home interest rates are like around 6%. That is like historically the average rate. like 5 to 6% is generally what you can typically expect from a mortgage. And so, to me, I feel like it would get a lot of people trapped in a position where they're not ever paying down principal. And um, maybe they can't refi because they owe so much still on that mortgage that it may not make sense for them to refi in anything that makes sense. I don't know. I mean, and two, like if you're trying to save $300 a month just to buy a house, paying a 0.5% or 1% to refi could be expensive. I don't know. Just my thoughts. To me, I would say, if you can't qualify on a 30-year mortgage, buy something smaller. I mean, there's plenty of smaller things out there, but I need to formulate my opinions on that. That way I can actually bring you guys something qualified. Guys, appreciate you all for being here with me today. Excited to be doing this from Mexico. Maybe I'll actually take y'all out to the beach with me tomorrow. I'm just kidding. I would not be able to get any Wi-Fi out there, but we will be doing this tomorrow again. Was it noon Central Standard Time? So I will see y'all then. Appreciate you guys for being here. Let's see. What's my opinion on gas stations? Like them or no? I can like them. It depends on, really, really depends on a lot of factors. We can talk about it later as well. Tattoo explanation, please. Thank you. I got all Japanese style tattoos. So I've got probably over 30 hours of tattoos. I love the Japanese style. You can always add on to it. It's pretty cool. Trump needs to bring a package for the first time commercial investment loan. Oh, dude, that would be cool. Like a first time commercial real estate investors loan where you can bring down 10 or 20%. The problem is it's just an investment. It's not like you're actually living there. That would be pretty cool though, to be able to get like a first time buyers deal. Anyways, guys, appreciate y'all. I will see y'all tomorrow. Thank you for being here.